What if you could sell your business for millions of dollars and pay zero in taxes? I'm not talking about small time numbers either. If you could exit for millions or tens of millions of dollars and 100% of the sale went straight into your pocket, would you do it? In this video, we're gonna walk through one of the absolute craziest sections of the tax code that you can take advantage of to keep an extra 6, 7, or 8 figures in your pocket when you sell your business. Let me explain. I'm a CPA that saved hundreds of business owners and real estate investors collectively over tens of millions of dollars in taxes. There's actually a few different ways to exit from your business and pay zero in taxes. Today we're going to talk about one of the single greatest sections of the tax code, how you can take advantage of it, some common mistakes that blow it for business owners that cost them millions in taxes, and some advanced methods you can take advantage of to multiply that tax savings. That section of the tax code is section 1202, Qualified Small Business Stock, aka QSBS. The IRS allows you to exclude 100% of your capital gains when you sell your QSBS up to $15 million or 10x the amount of your basis in your stock. So, what qualifies as QSBS? First, the business that you own shares in must be a C corporation based in the US. When you're first issued the shares, the company's assets can't be more than $75 million. This strategy is specifically for founders and investors who get in early. Next, the business must be an active business. It can't just be a passive investment corporation. Almost all businesses will qualify here. Additionally, you must have gotten the stock directly from the company, not secondhand off a previous investor. And lastly, the company can't be in certain professional services like law, accounting, and consulting. It also can't be a financial services business or a farming business. So all in all, the majority of business owners are going to qualify for this exclusion or can qualify with a little bit of intention and preparation. So what are some of the giant mistakes I see founders and investors make that completely destroy their tax savings? First, they mess up the holding period requirements. Once a business meets all the criteria I mentioned, the only thing you need to do is make sure you meet the holding period requirements and you're going to avoid taxes. You need to have held the stock for 5 years in order to get the 100% exclusion, or starting with shares you get after July 4th, 2025, at least 3 years for a partial gain. Most of the time, that's not going to be an issue, but there's two big exceptions I see people mess up constantly. One, they didn't file an 83B election and the 5-year clock never started running in the first place. The clock only starts running when the shares are fully vested, not when they're granted to you. However, there is an exception for tax purposes. If you file an 83B election within 30 days of being granted the shares, the IRS will treat the shares as if they fully vested and will start the holding period clock even if the shares haven't fully vested. Or two, the company wasn't a C corporation, which also means the 5-year clock never started running. The company must be a C corporation during substantially all of your QSBS holding period, so if there's maybe a few months in the beginning of your holding period where the company was another entity, you might be able to argue for the full exclusion, but I wouldn't try and take too much leeway on that. The company needs to be a C Corp. The second big mistake I see founders make is not evaluating the downsides of a C Corp before deciding they want to try and get QSBS. Don't get me wrong, the tax savings of QSBS when it works out are unparalleled. It might be the single best section of the whole tax code, but if you aren't actually able to pull off an exit, sometimes a C corporation entity structure can be costly. That's because of two reasons. C corporations don't get the qualified business income deduction, which is a straight up 20% deduction of the business profit that S Corps and LLCs get. Unless you're very strategic about running a fat salary to yourself to get all the profit out of the business, which may not be possible when you have investors, then C Corp income is double taxed. Once when the business has a profit, and again when you take cash out of the business. So you have to evaluate the pros and cons of both setups. Paying taxes twice and losing the qualified business income deduction could cost you significantly if you don't have a tax professional in your corner. That's why the tech startup world is the main industry that benefits from QSBS, because they often don't make profit that they're paying taxes on, so they don't have to worry about it. The third mistake QSBS founders make is they do all this work to build a great company, finally pull off once in a lifetime exit, but still get hit with 10+% state tax rates. 5 states don't conform to QSBS and will tax you anyways. California, Alabama, Mississippi, Pennsylvania, and New Jersey have no QSBS benefits. Hawaii and Massachusetts only give you a partial exclusion. So long story short, you can move residences to literally any other state and avoid handing over an extra 10 to 14% to California. The last thing I want to do is quickly run you through some advanced tax strategies to maximize your QSBS tax savings. If you think QSBS may be helpful to you and want to discuss these advanced tactics further, book a call in the description. My firm has helped hundreds of business owners and founders save tens of millions of dollars on their tax bills collectively. So there are 3 main advanced strategies you can evaluate to maximize your tax savings. The first one is gifting shares to a trust to stack the QSBS exclusion limits. If you're going to run into the limit because you're going to have more than the $15 million gain to report, you can give shares to a trust for your family members. You can gift up to $50 million in your lifetime without any tax consequences for you or gift recipient. Double that if you combine it with your spouse. So the smart play is to give shares to a trust that benefits your kids. You can even set up multiple trusts for multiple kids or grandkids to stack the $50 $15 million exclusion limit and avoid tens of millions of dollars in generational taxes for you and your family. The second advanced strategy involves rolling over QSBS into a new company if you haven't held the stock for 5 years. Not meeting the 5-year holding period is not the end of the world. If you have an exit before 5 years, you can roll over part or all the proceeds into a new qualified small business through a Section 1045 rollover, and you'll still avoid taxes on the exit. There's a lot of factors to consider here. It's best to run this one by your CPA before you have your exit. The third advanced strategy involves converting your company from an LLC or S-Corp to a C-Corp when it's clear you're going to have a big exit, before the company has $75 million in assets. Just because you didn't turn your company into a C-Corp from the beginning doesn't mean you're too late to get the tax benefits. You should evaluate the pros and cons of turning into a C-Corp with the specific goal of QSBS in mind for the founders and early investors. Section 1202 might genuinely be the greatest section of the tax code and can save you 6, 7, or even 8 figures in tax savings. So if you need a CPA firm that is actually responsive, proactive, and knows what they're doing, let's chat. Book a call with me in the link in the description. If you want to learn other ways to exit from your business tax-free, make sure you subscribe and comment any other tax or accounting topics you'd like me to cover. This is Tax Tone. See you in the next video.